Hey there, Greg from My Mortgage. Just wanted to talk about low equity margins and low equity premiums today. So, when you are buying a property and you have a smaller deposit, so you're borrowing more than 80% of the value of the property, the banks will charge you a low equity margin and or a low equity premium depending on the bank. So, just to explain that in a bit of context, so say you're buying a house for $500,000. If you have a deposit that is smaller than $100,000, then you're borrowing more than 80% of the value of that property. So we talk about it often with first home buyers around deposit. So if your deposit is bigger than 20%, the banks look at it in what's called loan to value ratios or LVRs, and that is the 80%. So they're only allowed to go to 80%, but they do have some exceptions where they can go over 80% lending. And when they do that, they will add on a low equity margin or charge you a low equity premium. So the banks do it all a little bit different, but what that is on top of your interest rate that they'll be charging you, they will put an extra margin. So normally, if you've got between 10 and 15% deposit, so the bank is lending you 85 to 90% of the value of the property, they'll put on about 0.75% of 0.75% onto your interest rates. If it is under that 85%, so between 80 and 85%, if you've got a slightly bigger deposit, then they will likely put on about 0.25%. And that is what they would say is the added cost for the risk associated with having a smaller deposit. Once you get to a 20% deposit or the bank's borrowing less than 80% of the value of the property, then there's no low equity margins or low equity premiums. One of the banks, what they do is they charge you an upfront fee, and most of the time we can get that added onto your loan. And that means they'll charge about 0.6% of the value of your loan. And they'll add that on. So it might be $3,000. They'll tack it onto your loan. And then they'll also put on a small 0.25, 0.45, somewhere around that percent low equity margin as well. So that low equity margin, it's only on there for the time that you don't have that 20% equity. So when you're borrowing more than 80%. So if your property goes up in value, we can get that low equity margin removed, which is great. Also, if you're going to be paying it down quite quickly, maybe you've got some more income coming in. As soon as you've paid down a chunk of lending, then we can get that low equity margin removed as well. And there's another video and blog about how to go about doing that. So if you've bought recently or a little while ago and you still have that low equity margin, it's definitely worth reaching out. We can run some numbers, check where things are at, check what the value of the property is. If we need to, we might need to get a registered valuation done, but most of the time we can rely on what's called a desktop valuation to find out what the value of your property is and then manage getting that low equity margin removed. So any questions around low equity margins, feel free to reach out. One of the team at My Mortgage or myself will be happy to help out.